Hi, this is Stuart Weems, and thanks for listening to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about 4 tactics that you can employ as a property investor to mitigate or at least somewhat reduce some of the headwinds that property investors are facing at the moment. So things like tighter credit and the potential abolition of negative gearing and increase in capital gains tax if Shorten wins the election, falling property prices, new apartment supply in some sectors and locations and states. Some of these are the headwinds that investors are facing. You'd be sort of excused, I guess, for almost giving up and thinking, well, either now's not the time to invest in property or don't invest in property at all. Well, firstly, I would say to that in times of high uncertainty or negative consumer or investment sentiment, can often bring about some of the best investment opportunities. And I'll share a story with you of my own towards the end of this podcast to demonstrate that. But if you're looking at these sorts of things, particularly tax changes and tighter credit and so forth, what can you do within your investment strategy or your investment approach to protect yourself as much as possible from all the risks? Now, we're investing, and with every investment, there's always some level of risk. So we can't fool ourselves to thinking it's a riskless exercise, but certainly we can do things to mitigate them. So let's get into it. The first tactic is to invest with owner-occupiers. And probably a better way to frame this tactic is to say, don't invest in types of property or locations that are dominated by investors. So a good example of that sector is the high-rise apartment market in most capital cities, but particularly Melbourne and Sydney and Brisbane. There's a lot of construction has occurred over the last 10 years in that space, in that sector, and those properties are typically marketed to investors. So the amount of units owned or apartments owned by investors in Victoria is around about 60%, about 50% in New South Wales. So that's across the board. I would suspect that the investment ownership in high-rise towers, residential towers, probably to be approaching or even beyond 80%. So the problem with doing that then is if there's changes to tax legislation and investors are scared away from the property market for a period of time, that obviously reduces the demand. Because those sorts of properties will stay in investor hands and they'll be marketed to investors. Whereas if you're investing in a location that's dominated by owner-occupiers, so more than 50% of properties in a location or type of property occupied by owner-occupiers, well, we've all got to live somewhere, right? So that demand is far more sustainable and less likely to be impacted by things like negative gearing and those sorts of things. So have a think about when you're investing, have a think about where you're investing and who's the predominant owner within that location. So the second tactic is invest before year 2020, probably before July 2020, really. So Shorten has stated that the ban on negative gearing and the implementation of the higher capital gains tax rate will only apply at a yet-to-be-determined date. So they've also confirmed that it won't be retrospective, and so it won't apply to properties bought before that yet-to-be-determined date. So if we assume the election happens in May next year, which is the latest it can happen, depending on if the ALP win, and depending on what majority they win with, they're still probably going to take them at least a year to get the legislation drafted, get out for comment, and then get it passed. So I think the most practical, earliest implementation date's probably at the beginning of the 2020-2021 financial year. So there's 1 July 2020. I think maybe they could implement it before then, but I think that would be really difficult to do. So if you want to avoid being caught by those changes, then clearly if you invest in property before 1 July 2020, you're probably going to be okay. Now, of course, they could win, the election could happen sooner, and they could pass the legislation earlier than that as well. So just be careful that that date obviously isn't set in stone. Tactic number 3 is level up on quality. So in my article, a recent article that I wrote for the Australian newspaper, and the links to that are in the show notes, I calculated that if the ALP's tax policies are implemented as proposed, that the impact would reduce the after-tax return on property by about 26%. So a quarter of the return is lost because of the higher tax rate. So I worked out, based on holding everything the same but just changing the tax consequences, that the return on property is about, after tax compounding annual returns, about 12.6%, but with the changes it falls to 9.3%. Still 9.3% is not so bad. The best way to mitigate I guess, known and unknown risks, because any clown could pop their head up and come up with a new tax policy that we're not even contemplating today. But the best way to mitigate that is really to generate as much return as possible naturally. Now, of course, it doesn't protect you. You're still taxed as a percentage of that return, so you're still going to be out of pocket by 26%. But if you can invest in a really great asset, and instead of generating 9.3%, and that's based on a 5% plus inflation capital growth rate. So if you can generate, say, 10%, then your after-tax return is still going to be in double digits, even if those tax policies are implemented. So in my book, Investopoly, I talk about the sort of subgrades within the investment grade property class. So, not every investment grade property is equal. And, a house on a rather small block of land, maybe 250 square metres, single fronted, 2-bedroom Victorian cottage, in a fantastic suburb in Melbourne, such as Hawthorn or Paran or South Yarra, in a nice quiet street, an asset like that is probably towards the upper end of that spectrum of investment grade, and as such you should expect then for that asset to generate reasonable capital growth, quite healthy capital growth in fact. However, an entry level property, which might be worth say $500,000, and it's probably in a 1970s block of apartments of maybe 10 or 12 or 15, pretty ugly looking sort of property, not necessarily very large, but still fundamentally sound in a good location. That's probably the entry level. And so the entry level property is not going to produce the same, or at least you can't expect an entry level property to produce the same level of capital growth that a higher end investment grade property. And what I've essentially done is drawn a link between, say, bond ratings and property ratings. So, a AAA rated bond has an extremely low chance of default, and typically issued by a government, the Australian government, for example. And that's an excellent great asset. So the 2-bedroom single fronted Victorian cottage would be a AAA rated investment property, whereas a BBB rated bond has a still investment grade, but it has a higher risk of default than a AAA rated bond. And so to draw the same comparison, that entry level 1-bedroom 1970s apartment is probably a BBB rated investment grade property. So I'm getting a bit sort of tongue-tied, but what I'm essentially trying to say is that, okay, if we want to reduce our risk, the best way to reduce our risk, and this is true with really every investment, not just property, is to level up on quality, to get the absolutely highest quality asset. If you own the best property, just notionally, if you own the best property in Australia, the best investment property in Australia, you're going to do well, aren't you? In the long run, it's going to generate great returns. Whereas compromising and getting average quality property, it's going to be more exposed to those market changes and taxation changes and so forth than a really good quality property. So number 3 is level up on quality, and number 4 is future-proof your loan structure. So I think when it comes to borrowing these days, the starting assumption has to be that you're never going to get any more access to credit. So what you're able to get approved at the moment, you should take the approach or view and base your decisions on the fact that the bank's never going to give you any more money. Because I think for a lot of people, that's a relatively safe assumption. And what that does do is it then mitigates some of the risk of, going and get a loan today and then thinking, well, I'll go back in a year's time and borrow more money then. The opportunity to go back in a year's time and borrow more money might not actually be there because of tightening credit, change in circumstances, and those sorts of things. So there's two things that you should think about in particular when it comes to structuring your loans. The first one is borrow as much as you can. Borrow the full cost and direct any existing cash savings and future cash surplus into a linked offset account. At least then you lock in and build in buffers into loans, etc. If you think you might need to do some repairs or improvements down the track, try and build in access to capital through your loans at that particular stage when you first purchase the property. The second consideration is repayments. If you go for principal interest repayments, and I've done a podcast on this, if you go for principal interest repayments, you'll save yourself nearly 0.5%, just under 0.5%, in interest cost. But the downside is that the cash flow repayment then is higher than if it was interest only. So you just need to do those numbers and work out, should you be setting up as interest only so you can minimise the cost, and would you have enough cash flow to be able to do that? Another option potentially is running the repayments through a line of credit, so that you just put the interest into the line of credit and the line of credit soaks up that principal repayment. And if you have that sort of structure, you're notionally not making any repayments. You've got an interest-only loan, but the interest rate you get is the principal interest rate, so saving you 0.5%. But now more than ever, given the credit tightening, now more than ever, I think you really need to get good quality credit advice and make sure your loans are structured correctly. Remember, we're playing the long game here. That all these risks, changes in tax and tighter credit and rising interest rates and falling property prices and supply issues, all these sorts of things, we've all seen it before. Over the last 3 to 4 decades, the property market, investment grade property, has generated fantastic returns. Often, capital growth rates of 10, 12, 13, 14, 15%. Over that period of time. And over that period of time, we've seen some massive changes. We've seen double-digit interest rates. We saw the actual introduction of capital gains tax in 1985, and even the abolition of negative gearing back then as well in 85 for a short period of time. We've seen economic shocks, we've seen recessions, we've seen market crashes, all those sorts of things. So the market has seen it all before. It will get through it. And in the long run, long-term investors that are really focused on quality, that are prudent, that are managing their risk and implementing with a really good strategy, will be rewarded in the long run. So don't worry so much. Don't necessarily read the papers. Don't worry about all the uncertainty. It actually could be your friend. And so let me share you a quick story about that. So I attended an auction back in October 2008. And a few weeks prior to that, in September 2008, Lehman Brothers filed for bankruptcy. And that was really the thing that really kicked off the GFC. And the share market was, in October 08, when I went to that auction, the share market was in free fall. In fact, it lost 35 in Australia. It lost 35% of its value between September 08 and March 2009. So that 6-month period was a terrible. If anyone remembers that market, it was really terrible. And according to the media, the world was over and business would change and everything would change. Anyway, I went to this auction, right? And I didn't think I had any chance of buying this property. And in fact, I was nearly going to pull the pin. And in the end, I thought, I'll go just to see what happens. But I didn't think I was in the market. Anyway, I bought the property for $1.21 million. And intuitively, I think in a normalised market, maybe it was worth 1.4, 1.5. So I got, I was pretty happy with the price that I paid, particularly thinking that it was going to be outside my price range. Now, that property would be easily worth $2.5 million today, but unfortunately, due to personal circumstances, I don't own that property anymore. But my point is that at times of uncertainty and low consumer sentiment, sometimes opportunities can arise, but you're only going to see them if you're looking for them. So the fact that we've got a little bit of negativity around property, we've got tighter credit, we've got some potential tax changes, all those sorts of things, perhaps it's actually a good window of opportunity to start investing and get in the market. Of course, we're taking a long-term view here, so I'm not suggesting that everyone should rush into the market now, or in fact that it is actually a good time in time. The time in the market, I've done the studies, doesn't have any impact on your overall returns. And there's a blog somewhere on our website about that. So, but look at this negativity as your potential friend, particularly if you're in the property market or you're looking to purchase a property. So that's it for this blog. The 4 tactics. I hope they're useful. And if you're enjoying the podcast, please jump onto iTunes and give it a 5-star rating. I'd much appreciate it. But until next week, bye for now.